Alright, what's happening, guys? Welcome back to another episode of Sensible Investing. My name is Jesse, and it's been a couple of weeks since I last posted. And the reason being is because, as you guys can tell by the title of my video today, I've been reading. And I've been really engrossed in what I believe is probably the best and most useful book on investing that you will ever read, which you have never heard of, right? And I've been absolutely engrossed reading this book, rereading it, going over it. And what I wanted to do today is really give you some of the key takeaways that I got from this book, which I believe would benefit yourselves as an investor of any level, right? Whether you're just starting out, you're an intermediate, or you've been going some time, I believe that the lessons in this book will benefit any investor looking to maximize and improve their returns. And so, without further ado, guys, the name of the book, ironically enough, it's The Art of Short Selling. And never has the saying been more true about don't judge a book by its cover than this book. Okay, guys? So don't judge this book by its cover, because this book, whilst it is all about short selling, most of the principles have almost nothing to do with short selling, right? Because it's all about being able to do high quality investigative research on companies, right? Whether you're looking for frauds, whether you're looking for gimmicks, whether you're looking for dishonest management teams, whether you're looking for trends and shifts in the consumer behavior that will then drive the company either up or down, this book is a 10 out of 10. If you want to know how to smell a rat and see if something is off, then you should read this and reread this and take the knowledge with you into all of your investments. You'll be able to really uncover some nuggets of gold if you know how to do it in the right way and know how to think about it in the right, take the right approach. Right, guys? So it's got nothing to do with discounted cash flows, perpetuity, something re-add back the numbers, fair value. It's got nothing to do with that, guys, right? It's about digging as deep as possible, getting lost in the weeds, and being really curious about each and every investment opportunity you come across. It really helps you to do two things and two things well. First of all, it helps you avoid massive pitfalls, right? And we'll get into that in a little bit just to explain what I mean. And it also helps you, now I don't mean timing the market by knowing when to buy or sell. What I mean is knowing whether the stock is undervalued because people have overlooked some key facts, or knowing if the stock is overvalued because people have gotten too exuberant and again they've overlooked some key facts. And a really good example that I can give you into this is the example of Luckin Coffee. All right, guys? So if you think about Luckin Coffee and you look at the story, you'll know that something was amiss. The people that started Luckin Coffee, they started this 3 years ago. They have no idea about coffee, right? They don't even come from a coffee background. They came from a car rental background, right? And they grew their stores to apparently more stores than Starbucks, okay? People have been doing coffee for 70, 80, 90 years. Experts in coffee, although I think that doesn't taste very good, right? But that's my opinion. Anyhow, they've been doing this for 70, 80, 90 years, and it took them 20 plus years to grow their stores to 4,200 in China, and yet Luckin came along and did it in 3 years. Obviously, something was amiss, right? And Luckin was saying, look, we're growing our revenues, customers love us, which leads us to ask, well, where's the money coming from, right? Because Starbucks is growing their stuff at 9%, same store sales is growing at 6%, and it's largely driven by China. So are people drinking more coffee? Are they winning, more business off Starbucks? So if you put two and two together, you can see that, something fishy is already up, and the picture doesn't really make sense, right? I wanted to give you a few examples and a few passages that I thought was very useful from the book. There's a lot of words, so just focus on the highlighted words, okay, guys? First of all, the top short sellers and I think best investors in the world, they read all day, as we already talked about. They talk to everybody about everything, and they've always got an ear out just for something that's either an interesting trend or perhaps something that doesn't add up, right, guys? So that curiosity needs to be there. They listen to what people are excited about, and if they're excited about for the right or wrong reasons, okay? And they listen to what people are bearish about and whether that's correct or incorrect, right? They look for evidence as to something is amiss, whether it's an accounting gimmick, right? Whether it's the true state of the corporate health, greedy insiders, a fad or a bubble, corporate appetites for cash and using it in the wrong way, overvalued assets, etc., etc. Looking at the leading indicators and not the lagging indicators, okay? So we're not talking about PE ratios and all of that stuff. We're looking at the actual leading economic indicators to help us understand what's going on. And so guys, what I'm going to do now is I'm going to give you some examples of some of the most useful leading indicators in stocks that ended up collapsing from the book and how that happened, okay? So this is a passage from a book talking about a retail store called Crazy Eddie. And the way that they figured out that this was a gimmick or a fraud was that the inventory turnover of their stuff had severely slowed, okay? So what that means is when the turnover of inventory slows, the consumer trend has changed, okay? And that's called days in inventory outstanding, which is a way that you can use to detect channel stuffing, right? And channel stuffing is when a supplier overloads the channel to inflate the numbers in the short term, but then having to write it off or impair it, say, a year, 2 years from now. You know, obviously they want to push the stock price up, right? Next example. This was an example of a retail store which was hyped up to be the next big thing, right? And it really talks about how when Wall Street analysts do site checks, they either go to the flagship store or they, you know, look at some kind of document about the store, right? They don't actually do physical site checks. So in this instance, the short sellers actually went and did a site check at every single store that the management was hyping up and saying, you know, this is the next big thing, we're going to overtake fashion. And then the stores were empty, right? So 2 years later, the stock price went down 90% and it fell over and crashed. And again, guys, you know, nothing to do with ratios, all about leading indicators. Next example, this was an example about an organic, you know, foods and meat store, right? And their value proposition was that we've got the most gourmet cuts, you know, it's perfect for every consumer. Our consumers love us. They'll come back every time. You know, the spreading word of mouth and their friends were coming over, okay? And again, so what happened was the short sellers, they went and they stood outside a lot of these stores and they actually just impromptu just surveyed every customer coming in and out of the store. And what they actually found out was that the cuts were terrible, and it wasn't actually gourmet, and the clerks didn't actually know anything about meat, okay? And again, this company fell, you know, 80-90% and then ended up filing for a Chapter 11. So the next example is another really, really interesting example, okay? And this was an example called Jiffy Lube, which was a lubricant company, and the bullish thesis was that, you know, this is a revolutionary new lubricant. It's going to overtake all the other lubricants, and people are going to service their cars no matter what, etc., 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 okay? And so, you know, and people didn't even bother to read the IPO document. So what the short sellers did was they dug back a couple of years to actually read the IPO document. And what they found out was that the reason why their EPS and their revenue grew so much is because, you know, they had been putting all of these non-recurring once-off revenues like selling assets or, you know, selling buildings, artificially inflating the numbers, right? So Wall Street took the story and said, oh, you know, we project a discounted cash flow of 40% growth and it's trading 70% below intrinsic value. But really, they didn't even look at the IPO document saying, look, most of this is just, most of our operating income is one-off non-recurring. And so guys, looking at these two paragraphs that I put into here, especially at the highlighted passages, I wanted to give you an example of a company that I was looking at that seemed interesting, but I ended up passing by using some of these examples in the book, right? So as you guys can see here, the level of work, the fine-tooth work, is too costly for brokerage analysts, right? And they don't have the time or skill to perform this. So rather than just talking to their competitors or their suppliers, they'll just talk to management, right? But, you know, obviously you don't want to talk to management because they'll always tell you everything's good. So the company that I recently looked at was a company called Upwork, and I'm sure that you guys are really familiar with Upwork, okay? Now, when I was reading through the documents, like the earnings calls, I had a feeling that something was off in terms of their enterprise product, okay? Because their management kept saying small, medium business were doing really, really well, but hang on a second, in their prospectus document, they said that, you know, freelancing in the gig economy, that's going to be the big thing for HR departments, right? So I'm thinking, well, the enterprise customers are the only ones with an HR department, so why are they not talking about the enterprise product? So what I did was on LinkedIn, I reached out to at least 50 people that used to work there that left. And I especially targeted the ones that had stayed, less than 2 years, right? Because typically if you leave under 2 years, you're not really happy with the company, right? Otherwise, why wouldn't you stay long term? And I reached out to 50 people, and only, 3 or 4 people got back to me. But what I found out was that the enterprise product was an actual flop, right? They launched it and relaunched it 6 times. The value proposition was not sticking. And so as a result, I passed on the company, and they absolutely missed on their next call, citing weakness in the enterprise product. Okay, so that's a really useful takeaway that I got. And much like the passage, I don't care about talking to management. I want to talk about people that used to work there. There's, their customers, competitors, etc., etc., etc. All right, guys, and then final example, I just wanted to leave you with this, and then that will be the end of the video, okay? So, guys, this example that I wanted to leave you with, this was one of Peter Lynch's best performing stocks, okay? And it was Legs Hosiery, which is now owned by Hanes. And when he was looking at going long on the stock, he couldn't care less about talking to the management team, right? He was talking to his wife and her friends, because as a heterosexual male, there is no way that you can know that this hosiery is of a higher, heavier denier, which is less likely to develop a run than normal hosiery, and that's very important for women because they don't want to keep replacing the tights, and also they want to be able to get their leg shavers and waxing papers for their leg hair, as well as other stuff in the supermarket at one place. And conveniently, that's exactly what Legs did, was they placed it next to, the razor blades, right? So that the girls can get it all in one, and then they don't have to leave the supermarket and go all around, okay? And this was one of Peter Lynch's best performing stocks. So really, guys, that's the message of the video, okay? Look at the leading indicators, talk and listen to people who nobody else is talking to, and then you'll be able to find out insights about your next investment that nobody else will. So guys, look, that is the end of the video. I hope you found it useful. And guys, I would really recommend you reading The Art of Short Selling. Best book on investing and stock markets that you will ever read, and that you probably never heard of. All right, guys, so until next time, happy investing.